Welcome to part 2 of the accounting cycle. In this video, we examine the process wherein we prepare and post accounting adjustments, typically through accruals. I don't remember where this quote came from, but it's apt for this lecture. 1,000 monkeys in a room typing on typewriters will randomly create Romeo and Juliet long before they come up with accrual-based accounting. Despite what this quote says, there actually is some logic to accrual-based accounting. It keeps the revenues and the expenses in the period where they occurred. So that way, your monthly revenue or your yearly revenue is an accurate depiction of the efforts you performed and the expenses that you incurred while performing your job. But it's not an easy concept to master, at any rate. In this series of videos, we've been working with Mr. Saul Goodman's attorney at law practice in Albuquerque, New Mexico. There's his chart of accounts for all of the different accounts within his financial system. At the end of the month, when Mr. Goodman performed legal services, purchased equipment and furniture for his office, as well as paid himself, he prepared a trial balance, which lists all of the accounts from the general ledger with their respective debit or credit balance. This allows us to see whether our debits and credits indeed equal one another, which they should if you've recorded everything properly, and it allows us to see where we need to make adjustments to our ledgers. For example, we see that we have transactions for prepaid insurance, and we'll need to write that down to show that we don't have as much of that as we started with. A month has passed by and we've used a month of our prepaid insurance premiums. And we also see that we have equipment, which we reflect as accumulated depreciation throughout the life of the assets. Let's look at the 4 primary categories of adjustments and a couple examples for each. The first category of accounting adjustments deals with prepaid expenses. This is like the insurance example that we saw in the previous video, as well as the allocation of the use of our equipment over the time that we intend to use it. In these cases, we've already paid cash to acquire the asset, but now we have to write it down to show that the asset is no longer as valuable to us. So in the first example, we paid for $1,200 worth of insurance to protect our law firm from malpractice. It's now the end of the month, and we need to show that we only have 11 months remaining of this prepaid insurance policy. The total policy amount was $1,200. There are 12 months on the policy, so therefore, we can average out our insurance expense at around $100 per month. To show that we've used this up, we write down our prepaid insurance account with a credit of $100, and we write up our insurance expense by $100 to show that that's how much money our firm expended to protect ourselves from malpractice during the first month of operations. Another typical example of adjusting your books for a prepaid expense is that of depreciation. We acquired $4,800 worth of office equipment in the previous video when we were setting up our business. But we know that our office equipment is going to lose its value over time. You're not going to be able to resell it for the same amount as you bought it for. So we have to figure out how to allocate the cost of the equipment over its useful life. Remember from your financial accounting class that we compute depreciation as the purchase price minus the salvage value, which we're told that is 0, divided by the expected life of the asset, which we're told is 48 months. This yields monthly depreciation expense of $100. We debit appreciation expense, and we know that expenses always rise to the debit because they offset our revenue, which rises to the credit. Likewise, we reflect the use of the asset in a contra account called accumulated depreciation. This allows us to keep track of the equipment on our books for what we paid for it, but also keep track of this contra account that shows how much of the asset has already been used. Now, the second category of adjusting entries has to do with unearned revenues. These are revenues that you haven't done the work yet. Let's take a look at what that means. On September 29th, Jesse Pinkman retains Mr. Goodman as his personal attorney, paying him a retainer of $10,000. We know that Jesse's going to hand Saul Goodman $10,000 worth of cash. And as Mr. Goodman does legal work for Jesse Pinkman, he's going to reduce the value of this retainer. But right now, at the time that Jesse hands him the cash, he hasn't done any work to justify that revenue. So we need to record it as an unearned revenue, which is a liability. What happens later on down the road when Saul Goodman has done the work? This is much later down the road, February 29th of 2020. And now Saul Goodman is helping Jesse Pinkman negotiate a real estate transaction. In negotiating this transaction, Mr. Goodman spent 10 billable hours and ended up acquiring the home that Jesse wanted in the Albuquerque Country Club neighborhood. Previously, we had credited a liability account or unearned revenue for $10,000. Now that Mr. Goodman has done the work, we can record revenue of $2,500 and subtract from that liability the $2,500 of work that he's now done. It's important to point out that the subsequent transaction does not involve any cash movement. We've already received the cash. We're just now recognizing that our firm has done the work to justify earning it. In fact, the adjusting journal entries at the end of the month should typically never involve cash. They should involve the other asset accounts, but never cash. Now on to the third category of adjusting journal entries. These occur when you know you're eventually going to have to pay a bill, but the cash hasn't left your bank account yet. Now let's look at what that means. Example number 4. After a month of operating as a legal office, Mr. Goodman has used electricity as well as water and sewer in his legal offices. He has not yet received the bill for these services from PNM, the utility company servicing the state of New Mexico, or the city of Albuquerque. So Mr. Goodman accrues a liability to keep place for the money he believes he'll have to pay later on. He debits utility expense so that the expense gets matched with the revenue that he earned during his first month of operations. And as before, this expense will eventually show up in retained earnings. The offsetting credit goes to the payable, the liability that's created as a placeholder for the bill he knows he's going to receive and have to pay later. The final example of adjusting journal entries that we'll discuss deals with accruing revenues. We make this adjusting journal entry to put a placeholder in for work that we've already done, but work where we haven't yet received the cash. So finally, let's assume that Saul acts as a conduit for Mike Ehrmantraut, receiving illicit monies on his behalf and then depositing these monies into an unmarked safe box. Saul Goodman invoices Mr. Ehrmantraut $1,000 at the time the deposit has been made. So based on our discussion of revenue recognition, we know that Saul Goodman has done the work, so therefore he can record the revenue on his books. He records $1,000 revenue, and eventually this revenue will hit his retained earnings on the balance sheet. As a placeholder for the cash he hopes he'll receive from Mr. Ehrmantraut, he creates an account receivable for the offsetting debit. Here again is our trial balance. The first two columns show the unadjusted trial balance from our initial recording of business transactions during the preceding month. The second two columns show the adjusting entries that we recorded during the month of September, our first month of operation. We then go on to compute the normal balance after these adjusting entries in an adjusted trial balance. And here we can see that our position increased by $10,000 for the cash we received from Jesse Pinkman and the account receivable we received from Mike. We also see the using of prepaid insurance and the accumulation of depreciation related to our equipment. It's also important to point out again that our adjusting journal entries typically don't involve the cash account. During the month of September, we created this unearned revenue for money we received from Jesse Pinkman related to work that we haven't yet done. Our journal entries, the accrual of expenses, the accrual of revenues, and the using of prepaid assets all involve an asset account and either a liability account or an expense account. They don't typically hit the cash account. The adjusting journal entry that we saw in February, when Saul Goodman has done the work for Jesse, is much more typical of the adjusting journal entry we would see at the end of the month. But for timing purposes, we do see this cash transaction here. In the next video, we'll look at creating financial statements from the adjusted trial balance. And in the fourth video, we'll look at closing the account so we can start afresh in the next period. Until then, happy learning.